We see extreme forms of leverage and speculation, which is meme coins, perpetual futures, leverage trading products. And then you see extremely conservative assets that are basically stablecoins. The vast majority of finance happens in between these two things, but for some reason, crypto has erred to the two extremes.
Hey everyone, welcome to the Smart Economy Podcast, where we ask your favorite builders the questions you wish you could ask yourself. This is a production of neonewstoday.com, and I'm your host, Dylan Grabowski. In this episode, we're joined by Ryan Galvankar, the founder of Plaza Finance, a programmable derivatives platform built on Base. In this conversation, we discussed Ryan's TradFi background and how traveling abroad opened his eyes to the real-world value that blockchain offers, why institutional investment is flowing on-chain, Plaza's long-term outlook on Ethereum, how Plaza leverages ETH-based liquid staking and restaking tokens, Plaza's bondETH and levETH mechanics, and so much more. Just a reminder, nothing said on this podcast is a solicitation to buy or sell any tokens, and that the guest or host might hold tokens discussed in any given episode. You can check out a disclaimer on www.neonewstoday.com. Also, if you enjoyed this episode, please consider rating and reviewing it on your favorite podcasting platform and sharing with your friends and family. Every rating, review, like, and comment helps us reach more people and bring you more of your favorite guests. With all that said, I really enjoyed chatting with Ryan, and I hope you enjoy the conversation too. Hey everyone, welcome to the Smart Economy Podcast. Today we're joined by Ryan Galvankar, the founder of Plaza Finance, a platform for programmable derivatives built on Base. How's it going today, Ryan?
It's going great. Thanks for having me, Dylan.
Yeah, I'm psyched to have you. It's always nice to follow in the footsteps of giants. I was mentioning before we recorded, I heard you talk about Plaza on The Interop, which is Sebastian Couture's podcast. So I was really excited to hear about what you were working on, and I can't wait to share that with our audience. But before we kind of jump into Plaza, I think you bring a really interesting perspective to the space in that you started your career kind of in the TradFi space or the traditional financial space. So before you started working on Plaza, can you just kind of walk us through the different capital managements you worked for, Merrill Lynch and things like this?
In college, I studied electrical engineering and finance at the University of Pennsylvania and quickly fell in love with markets and ways to use math and engineering to gain an edge. So while I was in college, I was lucky enough to have the opportunity to intern on the trading desk of Bank of America Merrill Lynch. Very much how the movies depict a Wall Street trading floor, full chaos, people screaming across the room. I thought it was a really fun environment. But for me personally, I liked to be thoughtful around what I was doing rather than just pure flow. So I learned from that experience that hey, maybe the better place for me is an investing role rather than a dynamic trading role. So after school, I was lucky enough to get a job at a hedge fund called Magnetar Capital. They primarily focus on structured credit. So things like pools of home loans, pools of car loans, finding ways to lever up those assets or construct risk reward profiles that are well suited for the Magnetar's investors. They're famous for being one of the funds in 2008 to benefit from the Big Short trade. And I was lucky to work with that team. I was there for 2 years in investing in things like home loans, car loans, physical aircraft, music royalties, anything with a cash flow that you can understand and value. And then after that, I went to a fund called Atalaya Capital Management, where I was able to take on kind of a bigger role helping lead and craft new strategies. So there I was focused on trading pools of corporate credit. So that was pretty exciting. And then when I was about a year into my time at Atalaya, some of my friends from college had started a crypto company. So two of my friends, Magnus and Barry, who lead Interchain Labs, previously known as Skip Protocol, had started working on Skip and were showing me all of the cool things people were doing on chain. That led me to start playing with lending markets and perpetuals exchanges. Got pretty excited there. At that point, I actually wasn't convinced that this whole blockchain decentralization narrative actually needed to exist. I was still a sheltered American who had worked at a hedge fund, and for sheltered Americans who work at hedge funds, the traditional financial system works pretty well for you. But then I went and visited my fiance's family in Kazakhstan and saw an economy that, while it's growing and is really robust, there are problems that mean that individuals can't always trust the banks or government programs. And that really clicked in my brain of, okay, there's all this cool infrastructure that people like Skip are building, and there's this massive group of people that need a highly functional financial system where they don't need to trust kind of the big institutions in their area. Okay, I need to go all in and make it at least on par with what we have in traditional finance. And that was kind of the path that led me to start Plaza Finance.
So Plaza, your kind of aha moment came within the past two and a half years?
Yeah, but before that, I'd FOMO'd into Bitcoin and Ethereum because some guys had told me oh, you're gonna miss out if you don't buy it. So I'd done some small size and thought of it as okay, if I put 0.5% of my portfolio in, and maybe it improves my risk-adjusted returns or whatever TradFi people say to convince themselves to put a small amount of money into crypto. But I hadn't really seriously thought about it until two of the smartest people I know had basically pivoted their entire careers to build in this space. And that's what really got my attention.
Yeah. When was the first time you stumbled on Bitcoin or Ethereum? Was it when you were studying? Was it before when you started your career?
It was probably in college, 2016, 2017. That cycle, I think there was a lot of talk about buying Bitcoin. I remember there was a guy on my floor who was moonlighting as contributing open source to Ethereum. And he was telling me about blockchains. But at the time, it seemed really crazy and implausible to me. And a little candidly, on Wall Street, we always had conversations about crypto is this huge speculative bubble with no real utility. Up until this month, Jamie Dimon was maintaining that he viewed Bitcoin was a scam. So it did take me a while to come around, but I'm fully around, and I've left my hedge fund job to advance the decentralized financial system full time.
Yeah, it's pretty funny because Jamie Dimon has actually, even if you still kind of dig through the weeds, he still says he doesn't really like Bitcoin, but the banks are starting to onboard into these ecosystems. They're starting to build on blockchain. I've probably had several guests in the pod dating back to 2022 who said that banks and big names that we would recognize were silently building on top of crypto rails, and they were just waiting for good regulation to come around before they kind of went public with what they were building. Was that kind of your experience in, I wouldn't say in the trenches, but you're probably rubbing elbows with a lot of different people across a lot of different traditional financial institutions while you're still working on Wall Street. So what was kind of was it a scarlet letter? Was it kind of a dirty little secret that people were building on these things, exploring them? Or was it just kind of yeah, I'm just getting off my portfolio, getting off 1% and getting a little bit of exposure? What was kind of the vibe back then?
Banks were looking at blockchains more from a hedging risk perspective. I think when you're a giant company with $1 trillion balance sheet, you have to allocate some amount of money to exploring new technologies to make sure you don't get caught with your pants down. So it was kind of a joke, these blockchain jobs at big banks for quite a while, where your job was to research and play with blockchain stuff and to write reports that senior executives then skimmed and threw in the garbage bin, but you weren't actually allowed to build anything. I think now that's starting to change as the regulations do become clear. So for a while, it was making sure the banks had people who knew things about blockchain so that if they needed to go fast because it became clear that their customers wanted it or it was going to disrupt their existing businesses in some way, that they were positioned for it. And then on the other end of the spectrum, there was a bunch of hedge funds that started market making in crypto. And for those, it wasn't necessarily viewed as a scarlet letter. Those folks were they're private funds. Everyone viewed them as doing whatever they could to make money. So it was fair game, but not a business that banks or kind of, I guess, middle of the road TradFi institutions were exploring. And then I think a shift started to happen probably in 2021, where we saw more private credit funds and private equity funds figuring out Bitcoin mining plays. Miners are super capital intensive. They require significant energy. So you have to do deals with real companies like energy utilities. So while I was at Magnetar, we actually did a Bitcoin mining financing. And I would say that started the shift of, let's say, the most adventurous hedge funds to the next tier that are maybe slightly more conservative, with banks always being positioned, not sure if they were going to do an internal stablecoin or like a private blockchain ledger to settle transactions. And now we're starting to see, I think, more the full spectrum of financial institutions in traditional finance figuring out how they're going to position. So I'm quite excited to see a lot of the bigger funds that were in the bracket of the funds I worked at, exploring things like loans backed by Bitcoin and things like that. So I think we've been given the promise that institutions were coming on chain for maybe like 5 years now, and it hasn't really happened. But I do feel like there has been material progress in the last couple of years, and especially with the regulatory shift, things are definitely accelerating.
Yeah, I know this isn't necessarily your area of expertise, but you just touched on it. I check maybe rwa.xyz. It's a phenomenal real world asset platform that just kind of shows like the status of tokenization of various different like commodities, equities. You're nodding your head, you understand. And private credit is kind of one of the rapidly growing tokenized forms on rwa.xyz. So what is it about blockchain networks that makes private credit so easily onboardable to come on chain?
I think these are like relatively stable funds investing in generally blue chip private opportunities. So if tokenized treasuries have some broad-based appeal, then this is like the next thing you want to try in addition to like corporate bonds. So I think that's what you're seeing maybe come on chain. I also think that there's just so much appetite for private credit that like Wall Street is looking for different ways to package it and raise more capital, and blockchains have classically been a way to do that. But what I'm actually more excited about than tokenizing private credit funds is those private credit funds actually like investing in on-chain opportunities, which I think is a bigger lift because it takes more infra. But that's the direction where I think it's like a material advancement in blockchain to see those funds flow. I think it's great for people around the world to get access to these fund vehicles through tokenization. But the bigger pool of money is actually the other way coming onto blockchains.
Are you starting to see that happen? Because you mentioned in your prior example that funds were flowing on chain to invest into like Bitcoin miners. And so now we have all sorts of different verticals in the Web3 space. We have like NFTs, DeFi, DAOs, other sorts of infrastructure. So is that like kind of Cambrian explosion of flows coming on chain and investing into Web3 verticals starting to happen?
I think so. I think there's two main buckets that are happening today. It's probably going to be a surge of venture capital. So that goes into basically every vertical of blockchain, and the ultimate LPs, like where the money ultimately comes from, is like large sovereign wealth funds or family offices. In terms of like on-chain DeFi activity, I don't think we've seen the big influx of TradFi capital yet. And that one's a little bit harder because it requires investment in self-custody, investment in infrastructure to gather data and analyze it on the blockchain. So until the opportunity set becomes sufficiently large, it's hard for these big funds to justify the upfront cost before they see the obvious opportunity of profit. So what we've seen is like faster moving, like quick money hedge funds have definitely come on chain. So I think the next wave will likely come when kind of there's sufficient retail volume or demand from retail such that the opportunity set for these big hedge funds is large enough to justify the investment.
Yeah. Do you feel that shift in retail sentiment is coming back? I mean, if I've been to maybe in the past like 6 months, like Binance Blockchain Week, Token 2049, both the consensuses, and you see, even go on crypto Twitter, you see a lot of negative sentiment from like bag holders and retail guys. But then, as you mentioned earlier, the institutions are finally coming, and there's a different level of excitement coming from the institutional space. So are we finally going to get like crypto Twitter happy? Is retail finally turning around, or are we still kind of like being led by institutions right now?
I think I'm not the right person to ask about this because I've not cracked the code on how to make crypto Twitter happy.
It's impossible.
I have a feeling that like crypto Twitter is well-meaning in the sense that we all want blockchains to succeed, but there's always going to be problems that people are going to complain about, and that's probably a good thing because that like drives progress and it holds projects builders accountable. So I think the primary reason why crypto Twitter is still, I guess, at a midpoint today, not happy, not unhappy on the spectrum of where it has been, is because the pros, the exciting part is like, okay, Bitcoin and Ethereum are doing well, and that's largely driven by institutional flows, like the things that we can practically see. But the thing that is lagged behind are altcoins, and a lot of crypto's Twitter is overexposed to altcoins. So until we see like altcoins like truly benefit from this rise in institutional interest on the Bitcoin and Ethereum side, I think crypto Twitter will continue to complain, and maybe rightfully. I hope altcoins do make a comeback. There's a lot of great projects that I think deserve to be valued higher than they are valued today. But I think it'll take time for that money to flow from the institutional side at least. So retail is still holding the bag on a lot of these altcoins.
Cool. Well, I think what Plaza's building is really excitable because it seems to be a bridge between the worlds that you came from and building on the best parts of the tech stack that blockchain seems to offer. And so a lot of our listeners are probably crypto native or maybe just crypto curious for the first time. And I would venture to guess that maybe a lot of our listeners aren't necessarily like Wall Street TradFi guys. So let's just do like a few Eli 5 definitions so that as we're going through what Plaza offers, people can kind of like have some context and understand. So when we hear the word like programmable derivatives, what is that in like an elevator pitch?
Yeah. Programmable derivatives, fancy term that I made up. It basically is a tokenized structure on top of a vault. So you take some assets, you put them in a smart contract vault, and then that vault can issue different derivatives that are backed by that underlying vault that represent different splits of the return stream of whatever is in that vault. When we talk about programmable derivatives, we talk about it in the context of our products. So our products are bondETH and levETH. They're essentially programmable derivatives of Ethereum. So we took Ethereum and we split it into a bond profile that is for those who want stability and yield and fixed returns, and a levered profile for those who can handle the volatility, want more upside to ETH. Both are packaged as nice tokens, so you can move them easily across other DeFi, across chains. They're always backed by this underlying vault.
Perfect. I was going to ask you what bonds are next, but I think you did a great job explaining it there. So maybe something that a crypto native might also have to wrap their head around as we continue our discussion is this concept of fixed quarterly coupons. So can you just describe what those are, how they relate to bonds, and then we'll kind of go into the unique ways in which bondETH provides these.
So a coupon is a Wall Street word for yield. It just means a payment of income. So bonds generally pay monthly or quarterly or annual coupons, which means you actually earn your yield at a fixed point in time every period. So our bond product, bondETH, is a bond backed by ETH that earns a quarterly coupon. So every quarter you get some income if you hold bondETH, and that income is in USDC.
Cool. So we're starting to kind of like get the flavor of the water for what differentiates Plaza from other kind of like DeFi solutions. But if you are out there and you're doing your BD and you're trying to onboard new users into your platform, what are some of the unique points that you say differentiates you from other competitors, programmable derivatives competitors, or even just like DeFi in general?
Why we built Plaza, and when we look at the DeFi landscape today, we see a pretty bifurcated approach by the industry. We see extreme forms of leverage and speculation, which is meme coins, perpetual futures, leverage trading products. And then you see extremely conservative assets that are basically stablecoins, USDC, USDT. The vast majority of finance happens in between these two things. But for some reason, crypto has erred to the two extremes because they kind of meet the needs of the earliest crypto users. The earliest crypto users were tech enthusiasts, risk takers, and they like leverage trading. And when you make profits on leverage trading, you need to put it into something safe. The other big group of early crypto adopters were those who have a strong distrust of institutions and want safety for their assets, and stable coins provide that. We view the kind of next iteration of the decentralized financial system as mirroring the functionality of the traditional financial system. So we wanted to create a mechanism where you can create all of the risk profiles in between to capture every type of investor. To on-ramp the next billion users into crypto, you need assets that meet their needs. So that's why we built Plaza as an engine for transforming the risk and return of any asset into profiles that are better suited for these different investors.
And Plaza's products are built on top of ETH liquid staking derivatives and restaking derivatives for the products. So maybe for like someone who's bought Bitcoin and has bought Ethereum, but doesn't necessarily know what LRTs are and LSTs are, can you kind of go into the subtle differences between the two and then maybe use that as a jumping point as to how like bondETH and levETH leverage those?
Liquid staking is basically taking your ETH and delegating it to someone who is validating transactions on your behalf and earning a reward from the blockchain network for successfully validating transactions. So you could think of it as using your Ethereum to secure the Ethereum network and process transactions. And for doing that, you earn a small reward that today looks like 2 to 3% yield on your Ethereum. That's what staking is. Liquid staking is basically taking some staked Ethereum, wrapping it in a token so that you can continue to use it across DeFi. So it looks like Ethereum, it feels like Ethereum, you can use it anywhere, but it's earning that 2 to 3% yield for helping secure the Ethereum network. Restaking is basically taking that staked Ethereum and using it to help secure other projects that are built in the Ethereum ecosystem and earning a reward from those products. So contributing those assets to ensure that kind of decisions being made by protocols are good and fair. And if you successfully do that, you earn some reward. And just like liquid staking, liquid restaking is basically taking that restaked Ethereum and packaging it as a nice token so you can move it around and do other things with it. We have built bondETH and levETH on top of liquid staked and liquid restaked tokens. One, because they're superior assets in the fact that they're yield bearing. If you just own ETH, that's great. You're exposed to ETH going up and down. If you have liquid staked ETH, we think the risk is extremely small and you earn an extra 2 to 3%. So that's a great product. And then restaking, right now, I think the yields are a little low for the risk of restaking, but we hope that they go higher or the risks go lower. And we think that this is like a great frontier for the expansion of ETH economic security. So also great assets to build on top of. But essentially, we wanted to take decentralized assets like Ethereum and create different return profiles that meet different investors' needs without taking away from the security of ETH. If we were to build on top of just vanilla Ethereum, then that Ethereum would be sitting idle in the Plaza Vault while our assets would be flowing around. By building on top of liquid staked and liquid restaked tokens, it's easy to convert your bonds or leverage token back to those assets. You can easily sell them on an exchange. So you have all the freedom and flexibility of liquidity, but you also kind of benefit and contribute to the security of the Ethereum ecosystem. You benefit from it in terms of the liquid staking or liquid restaking yield you earn. You contribute to it by using your Ethereum to ensure that the network is secure. So we think it's an extremely symbiotic relationship between ETH asset holders and the broader Ethereum ecosystem and the right asset to build on top of.
So is the vault like a composition of ETH native asset, like Rocket Pool ETH, Lido ETH, and then a bunch of these other LRTs?
Exactly. So the underlying vault that backs bondETH and levETH is Lido's wrapped staked ETH, Rocket Pool's ETH, EtherFi, Renzo, and then Kelp and a few others. We opted to work with the biggest and best LSTs because we want these assets to be secured. And one thing that we deeply think about is like the ratio of each of these assets in the underlying pool to make sure we're not overexposed or our customers are not overexposed to one or the other, and making sure that the balance between liquid staked and liquid restaked is appropriate, targeting kind of specific yield targets and also risk targets.
Is that kind of like an active management that you and your team do, or is there some sort of algorithm or protocol that like keeps a percentage of the basket in tune, like a fifth Lido, Fifth Rocket Pool, etc.
Yes, and that protocol is balanced. So it's a balancer V2 pool where we set the target weights based on our underwriting of kind of the properties of each of these assets, and Balancer's protocol helps them self-balance. This is one of the biggest protocols, truly foundational in the Ethereum ecosystem, several hundred millions of assets. So we're quite excited to work with them and think they're definitely some of the biggest brains in the space.
Yeah, I wanted to delve into this a little bit later, but I think now is as good a time as ever. If you look back over the past year, sentiment around just Ethereum in general has been very bad. But at the same time, you see all these RWAs predominantly onboarding onto Ethereum. So what's Plaza Finance's bet or outlook on the Ethereum ecosystem? Like, what made it easy for you guys to look past this negative sentiment, explore, people building on other blockchains, other ecosystems? What was it about Ethereum that made you want to double down?
So if it's not obvious by the fact that we built on Ethereum, we're super bullish on Ethereum. Ethereum is the most mature blockchain that exists today, in the sense that all of the tooling is well built. It's truly decentralized. Institutions trust it. Ethereum has the vast majority of DeFi TVL, which is a strong signal that the biggest money in the space is comfortable holding it on Ethereum. And a lot of the negative sentiment was based on properties of Ethereum that I actually view as a good thing in the long run, meaning Ethereum's negative sentiment was largely driven by Solana taking off and the Ethereum community feeling like, hey, they're shipping really fast and Ethereum changes every 2 years in a very marginal way. That's actually probably a good thing for big institutional capital. You don't want the ground beneath you shifting really massively, where you have to think about am I introducing new risk on my $1 billion of assets? Do I need to think about rebalancing here? If the infrastructure is relatively mature and stable, that's quite beneficial. So I think the Ethereum ecosystem is quite thoughtful around the changes that get made. We saw the sentiment shift of okay, we haven't been left for dead after a couple of years of, I guess, quiet building from the Ethereum Foundation when we got the Pectra upgrade. So that addressed what I thought were the two biggest problems in Ethereum, which were one, gas. So making it cheaper to do transactions on Ethereum, and two, smart wallet support. So making it easier for users to be able to transact on Ethereum through the user experience. Once we got those two things, we saw that sentiment shifted quite materially, because it was kind of a signal that okay, Ethereum is still progressing and it's at a pace that's appropriate for the amount of capital on it, and the changes are thoughtful and in line with what the main problems are. So yeah, I think blockchains are filled with periods of extreme bullishness and extreme bearishness. Ethereum has had its fair share of both. I'm very happy to say it seems like we're on the other side of the cycle, meaning that sentiment has shifted to be quite good on Ethereum. But regardless of whether it's good or bad, we're long-term believers, because we think that the tooling and kind of philosophy around development is right for what Ethereum is trying to be.
Yeah, and so I like to be delicate when I start talking about the price of digital assets, because that's nothing we can control, and anybody who guesses is just pulling a guess out of their ass. But we definitely saw and the products you're building are addressing ETH, the asset, and everything you just said is, these are the pros for ETH, the architecture. This is why the architecture is going to continue to persist and why people will continue to build on it. But at the end of the day, the beauty of blockchains is that they have the economics built natively into the stack. So we can't not address things like token price. So I'm not asking token price, but I want to delve into a little bit about what your theories might be for why ETH, the asset, maybe has not appreciated in value as much as its network activity has. I'm sure that maybe the Pectra upgrade and a lot of the other upgrades that have come recently, and maybe even the perception of the Ethereum Foundation, might have helped boost the price in the short term. But where was the disconnect? Because we're seeing all these RWAs come on chain. We're seeing all these active uses, active wallet addresses still using Ethereum. We're seeing TVL and DeFi activity picking up, but the asset itself is kind of slow to capture that. And so maybe we're still at a place in blockchain where the market still doesn't fairly value the price of a digital asset or whatever. But like, what's kind of your outlook on how a native asset accrues value? Because I do think that this probably impacts the products that you guys offer at the end of the day.
So I think part of the reason why ETH didn't accrue a lot of value in the last, I guess, half cycle was Ethereum faced a scaling problem a couple of years ago where Ethereum block space became extremely expensive, gas was really high, and the blockchain became virtually unusable by the majority of people because who's going to spend $200 to send a transaction? So Ethereum's solution was layer 2 scaling. So rollups and other chains that basically post proofs to Ethereum. So transactions happen on these other chains and proof that they were successful and legitimate gets posted to Ethereum to reduce the cost and burden on the main Ethereum chain. What ended up happening is all the transaction activity moved to these layer 2s, and Ethereum, the chain, was accruing far less fees, which impacts the burn of Ethereum through kind of the Ethereum burn mechanism. There's a lot of debate in the Ethereum community whether this was a good thing or bad thing. My personal take is this was a good thing because it diversified the kind of transaction execution environments on Ethereum. So I think it makes the broader Ethereum ecosystem more decentralized. And two, I think that Ethereum is at a point in its scaling cycle where the direct fee revenue probably shouldn't be as tied to the value of the token, meaning that some blockchains, some tokens definitely should be valued based on the revenue accrued. That's how stocks are valued. You discount the cash flows to present value and you say, like, this is what it's worth today. Ethereum should be valued probably more like Bitcoin in that it is valued based on what it secures and represents. So if Ethereum secures the decentralized financial system and the decentralized financial system is worth trillions of dollars, I think Ethereum in itself should be worth trillions of dollars. In the same way that Bitcoin is kind of viewed as a multi-trillion-dollar asset because it is digital gold and represents freedom and safety of money. So I think that's the shift that Ethereum is like undergoing, this like revenue valuation to something more intangible, I would say. So that friction point probably led to a lot of negative price action because the revenue was growing down, but the utility of the network and value of the network was definitely increasing. And that seemed like a market disconnect of like not shifting to value it on these other properties that are clearly moving in the right direction.
And so Plaza is not built on ETH1, it's built on top of Base. So why did you guys opt to build on an L2? And maybe you can also share a little bit of the thought process that went into choosing Base as the L2. Why not like Arbitrum or Optimism or anything else?
We built on an L2 because we want to give users as low transaction cost as possible. So L2s are still cheaper than L1 in terms of being able to move your money around. And the bridging process between ETH L1 and L2s and L2s to other L2s is quite good today. So you don't give up anything really by building on an L2 versus an L1. Why Base specifically? We went through quite a process for picking Base, and it was very clear at the end of the process that Base was like the obvious choice. One, I think they're super focused on UX, which is quite important for on-ramping the next billion crypto users. Coinbase has already won the market in the US for centralized exchange. They are the most trusted party. They've done it for more than a decade now. They custody pretty much all of the major ETFs, like the underlying crypto assets. So they have this institutional and retail trust that is impossible to replicate. With the kind of shift in regulations on how crypto companies can market to Americans and the level of focus that the US now has on, I guess, crypto as a strategic initiative, we think that the US is going to massively on-ramp into crypto. And when they do, it's coming through Coinbase. So having a really good user experience of you onboarded through Coinbase, you move to Web3 via the Coinbase wallet app, and then you can use apps like Plaza within that app without downloading anything else, all without gas because Coinbase sponsors gas, is the winning UX. The trust with institutions, another great thing. And we like that they're very transparent about how the sequencer operates of the L2. So how transactions get ordered and processed before they're proved on Ethereum's chain. That helps prevent a lot of weird things that you actually see on Ethereum L1, which is like very technical term, but MEV, like sandwich attacks, people front running transactions, things like that. That happens on Ethereum L1, but it does not happen on Base.
I'm from the crypto class of 2017, and I basically didn't use Ethereum at all for my first 5 years in the space, because I remember when CryptoKitties clogged Ethereum and made it too expensive to use back then. And then come like the second bull run after that, NFTs, all these things were kind of like jacking up the price of Ethereum to use. And it wasn't until I started using Base that I started reevaluating my relationship with Ethereum as a blockchain user. So personally speaking, anecdotally, like Base is what brought me back to Ethereum and brought me to EVM land. So I'm curious to hear if maybe there are any kind of relationships or doors that have been opened for maybe larger scale players, TradFi guys, institutional players to look into what Plaza is building as a result of building on top of Base. Like, has this been a conversation starter for you with particular users or clients?
Yeah, it certainly makes the conversations easier. Like, these large crypto institutions, most of them, if you're a big company, you don't have a hot wallet on your MacBook. You don't even have a ledger with your private key. You need some like real custody solution, because maybe there needs to be 15 people in your company with different levels of authorization to do different things. And you need to be able to go to your shareholders and say, if something goes wrong, well, it was those other guys, not us. So most of them all use Coinbase custody. So having the conversation of, okay, your assets are in Coinbase custody, the opportunity we're presenting is on Coinbase's chain, you already trust Coinbase. It makes the conversation a lot easier. With a lot of other L2s, they either have to underwrite decentralized tech, which means they need to hire people to think about how the blockchain works and make sure it's fair, or they need to trust some party. If they're going to trust some party, if they already trust Coinbase, it's relatively easy. So we found that conversation is a lot easier being on Base than it is on other chains. With crypto native institutions, I would say the difference between Base, Arbitrum, Solana, and Hyperliquid it's actually like pretty marginal. They're all pretty much trusted, but it's specifically for like that 1 degree removed of like, oh, I've heard of Coinbase, but I don't really know blockchain stuff. That Coinbase and Base are a much easier conversation to have.
Yeah, and so I think one of the killer use cases for Plaza is that you're catering to different risk appetites. So even just looking at like the 2 flagship products, bondETH and levETH, they go after the very different ends of the spectrum for risk in this space. So I want to talk a little bit about bondETH and who are the types of folks that are interested in bondETH. What's like their average risk appetite like? Are they willing to be a little bit degenerate, or is this quarterly coupon yield something that is able to make it a stepping stone for them to onboard into Web3, into digital assets?
bondETH is very much not a degen product, although I have seen some people talk about leverage looping bondETH to speculate on the yield. But the primary user of bondETH is someone who maybe Ethereum is too volatile for them. They don't want to watch their portfolio go up and down 5% every day. That gives them stress. They would rather earn some steady yield. They probably already have stable coins. And what they're seeing with stable coins is, hey, I can lend them out for like 4%, and that's maybe not enough yield for the inflation I need to fight in my country. So they're looking for something that's maybe a little riskier than a stable coin, but not as risky as Ethereum. And that's really the sweet spot for bondETH. So you want something that hovers around $100. It's not pegged, but it's relatively stable, and it earns a 10% yield because it's a high yield bond backed by Ethereum. That's probably the right bondETH customer.
Can you just go into a little bit there? Because like the $100 is kind of like the sweet number. Where is this coming from? Like, why am I only able to buy $100 of bondETH at a time? Why, like, can you just delve into that a little bit more?
Yeah. So bonds in traditional finance are generally quoted at around $100 for what they call par. So we made bondETH the same. So it tends to stay around $100 per bondETH. You can buy as much or as little bondETH as you want. You can buy it like fractionalized to any small number or as much in one transaction as you want. But generally, each bondETH stays around $100.
What's the way in which you kind of like keep that peg? Because as we are very well aware, digital assets are extremely volatile. I mean, in the past year, we've seen Ethereum go from anywhere from $3,000 to $1,500. So what's kind of the mechanism that keeps that peg-ish kind of like stable $100? How do you guys keep that?
bondETH can experience true price discovery. So it can fall to 90, it can go up to 110 if the market feels like it should be priced that way for the risk. So first of all, we let the market price risk. We don't want to fight the market. Like where protocols blow up is when they're trying to maintain a peg and the market is fighting them because they've had some issue. So bondETH can freely float, but essentially where it gets its stability from is the fact that there's this vault of ETH liquid staking and liquid restake tokens that sit there, and the value of those assets is always significantly greater than the value of the bondETH outstanding. So right now it's actually 2 times as much value of ETH in this vault as the bondETH outstanding. And where that excess comes from is all the people seeking leverage. So effectively what's happened is both the leverage and bond investors have contributed some ETH to the vault. And that vault has promised these bond investors, hey, we will pay you your steady return. The leverage investors are taking first loss and covering your position. So as ETH moves up and down, they're the ones who their position goes down or up based on that volatility of ETH in an amplified way. So they're like the buffer for bondETH that kind of protects your position.
And you mentioned that maybe the type of client that is buying bondETH is maybe like on the lower end of the spectrum when it comes to risk. Maybe they also hold stable coins because they want to get that yield, but they want to chase a little bit of a higher yield. So when you're talking with these folks, how do you kind of help them grok with how bondETH might fit into their portfolio? Like what's the allocation percentage that a lot of these customers or clients are kind of identifying for bondETH when it comes to like their portfolios?
If you've ever talked to a financial advisor or watched a YouTube video or used a robo-advisor, you probably heard that you should be exposed to like 60% stocks and 40% bonds because the stocks are where you find growth and the bonds are where you find stability and yield. And sometimes the stocks will do better and sometimes the bonds will do better depending on how the market is doing. We think that crypto should move in that direction. So we think that people should hold some bonds for steady yield to smooth out their volatility. They're not perfectly correlated with the underlying crypto assets. So to use big finance words, it improves your risk-adjusted return to have not perfectly correlated assets all sitting in a portfolio. I'm not recommending 60-40 specifically. I think you should do what's right for your risk tolerance. I'm relatively young and I like to take risk. I'm the founder of Plaza Finance. That inherently was a risk. So I might skew more towards higher exposure to like something like a leveraged asset or a spot asset and lower on the bond side. But for someone else who's maybe older or less risk seeking, maybe it looks like 60% bonds and 40% stocks. So in this case, in the decentralized financial system, we think people should be able to kind of move their risk along a spectrum based on what's suited perfectly for them. And having more safe assets like bonds on chain that are decentralized, so you still don't have to trust an institution or us even when you buy them. We think that kind of introducing those assets helps improve their risk-adjusted returns, and creating this ecosystem increases the number of people who are maybe willing to try decentralized finance. So if you're out there and you don't own crypto, maybe this is a good uncorrelated thing to put in your portfolio. If you do own crypto, maybe it's a good way to improve your risk-adjusted returns.
Yeah, I like it as it's an interesting barbell strategy to kind of like go on the other side of the risk spectrum and have an asset that does return a stable amount that you can kind of depend on an annual basis. And so that's kind of what I wanted to ask next, actually. So how does bondETH ensure payout of 10 USD per year? It's 2.5 USD per quarter. Are there any situations in which a catastrophic market event happens and bondETH cannot return 2.5 USD per quarter? Or are there other market situations where it does return more than 2.5 USD per quarter?
Yeah, so it produces a stable 2.5 per quarter. And how that's generated is through the yield of the liquid staking tokens that underlie it, and also leverage investors paying the bond investors for their leverage. So we basically take some of the assets in the pool backing bondETH and levETH every quarter, and 2.5% for the coupon are sold in an auction process to generate the USDC to pay the bond coupon. As ETH goes up and down, you either need to sell more or less to generate the same fixed 2.5%. The protocol is unique in that it self-balances, meaning it'll de-lever or lever up as market conditions change to ensure that there's always enough assets to generate kind of the stable return. Why you are paid a 10% yield when the risk-free rate in the market is around 4.5% is because there is more risk than a treasury bond. It is not risk-free. So that I want to make perfectly clear. And the risk here is that if ETH falls 90% in value in one day, that could drastically impact the ability to continue to pay out the fixed 10% yield. So what the protocol does is it simply pauses coupons. You always have assets backing your bondETH that you can redeem out of it. So if you want to get your money out, you can. And at that point, the protocol waits for the price of ETH or the leverage of the protocol to return to a state that continues to support coupons. So it pauses until the protocol is ready to restart and continue paying. So if you are a long-term believer in ETH as an asset, maybe you think ETH is overvalued today, but you think ETH will always be worth something that is material, then bondETH is a way to make sure you get a fixed payment for forever, basically. Even if ETH falls significantly, the worst that happens to you is you skip a couple payments and your payments restart. That's kind of what you need to believe to own bondETH and be comfortable, or you need to feel like the 10% yield covers you for that risk.
Has there been a time in the history of Plaza's existence where coupon payments haven't been able to be distributed on a quarterly basis?
No, and there has not been an instance in ETH's history where coupons would have been paused, but if it can happen, it eventually will happen. It's just a question of, is it 100 years from now or is it a year from now? And that I don't speculate on. We just worked on building a protocol that can survive every market condition that we know.
Sure. So can you share a little bit more about the auction process? Is this like Treasury Direct where I have to put in a monthly bid or a weekly bid to buy a treasury bill? Is this done at a more rapid rate or frequency? What's that like?
It's once a quarter. Anyone can participate, though we think it'll be really hard for the average investor to beat out a market maker on this specific piece. But it's basically the protocol selling ETH for USDC to pay out to bondholders. So it's an open auction where best bid, so the protocol gets the most efficient price wins. And generally for the size of the protocol, you would be bidding to supply order of magnitude millions of USDC for ETH. So maybe not something that's super consumer focused, but one of the core mechanisms to be able to swap assets in a way that's safe, price efficient, transparent, and open to everyone.
Very cool. And so as we kind of zoom out and wrap up, I do want to talk a little bit about levETH. You guys have kind of a killer slogan, leverage without liquidation. So can you just share a little bit about the underlying mechanics of levETH, how one can have leverage without liquidation, and then also kind of expand on the relationship that levETH has with bondETH and the payments and things of this nature?
So levETH is levered Ethereum. What you've effectively done when you buy levETH is you've borrowed the ETH of bondETH holders. So you are providing the cushion for bondETH holders. You're levered. So if ETH goes down, you take the L, so bondETH investors don't. But if ETH goes up, you're the one who benefits from all that capital appreciation, whereas bondETH holders have opted for a steady yield. It's packaged as a nice token. So unlike trading leverage on a perpetuals futures exchange, you don't have your assets locked on that exchange. You can use other DeFi. You can send them across chain. You can hold it in cold storage in your wallet if you want. And where the liquidation-free aspect comes from is the Plaza AMM. So we talked about how the protocol is self-balancing. As ETH prices fall, the protocol is incentivized to de-lever levETH. When ETH is going up, it's to lever up levETH. This aspect keeps it such that there is always ETH in the Plaza vault that you can redeem your levETH for. We're not saying that you can't take a loss on levETH. Like, levETH is more volatile than ETH. If ETH goes down, levETH will do worse than ETH. If ETH goes up, levETH will do better than ETH. That's an inherent property of leverage. But as ETH falls, let's say in that 90% down scenario that we talked about as Armageddon, your levETH will asymptotically approach zero rather than instantly jump to zero and close out your position. So if ETH price recovers in the future, you participate in that recovery and you're not closed out of your trade like you would on another exchange. So for someone who is sitting there and like, I don't know what ETH will do tomorrow, but I know in 10 years it'll be significantly more valuable because I'm a strong believer in ETH, this is the product that was built for you.
Can you share a little bit of insights then into how the product fared post-Liberation Day? When we saw massive drops across the whole crypto industry, ETH got hit really hard. I think it went down 40% at its top to bottom this year in 2025. So what were kind of like the lessons learned? Did bond or levETH perform in the ways that you guys had thought? Did your clients and users kind of like hodl onto the assets in the way that you were expecting clients and users to?
So Liberation Day was before the protocol launched. So we were on testnet. Nothing broke on testnet, which felt good. I think the protocol, with ETH price falling, the protocol did in fact delever on testnet. So that felt quite good. Since levETH has been live, it was like ETH has done quite well. So it has performed at about 2x the price performance of ETH, which is great. Happy to see our customers win. But the protocol, I guess, since live has not seen a massive drawdown of ETH. We've seen 10% moves in ETH down, and kind of the protocol has performed as expected, which is levETH falls 20% in a day, and that's scary for people. But generally, the trend has been upward, so it has recovered in the few days after. So yeah, we feel like it was quite battle tested on testnet and through historical simulations. So we'll see how it goes with the next market test.
Yeah, knock on wood. So kind of zooming out and wrapping up, I think the elephant in the room is that Americans can't quite use Plaza Finance right now. So what do you guys need from a regulatory body or a legislative body here in the States for Plaza to feel comfortable to be able to open the doors for American clients and users?
Yeah. So one thing that we are waiting on is what it looks like for decentralized derivative regulation. So there's tons of regulations around derivatives. There's starting to be more color around tokens, but we are kind of in this next bucket of like what happens when both are together, and the regulation is totally unclear. If there's a license that we can apply for, we'd be happy to do that because we want to service Americans. But today, like, that process is sort of vague. We hope that there's going to be more clarity in the next couple of months. But for now, Plaza Finance is primarily available to those who are outside the US.
Maybe this is gray area or not an area you can speculate on, but what about like secondary markets? If you go on Uniswap, you can see bondETH and levETH, though just trading one ETH into those pools creates a lot of slippage. So it doesn't necessarily seem like there's a robust secondary market. Is that something that's like out of your control, out of your perspective? Or is there kind of like a way around these kind of setbacks or regulatory uncertainties? Like, are secondary markets going to be a thing for bondETH and levETH, or is this kind of out of your purview?
Yes. So one of the core advantages of Plaza is it's a permissionless protocol, and bondETH and levETH are tokens that can trade on any exchange. So we can't market bondETH or levETH to US customers. We can't service them on our front-end UI, but US customers can theoretically buy them on Uniswap or Aerodrome. I think Aerodrome has the deepest liquidity. If those platforms service Americans. So it's just a token that you can buy. So there's no restriction there.
So what are kind of like the next steps for Plaza? What's on your roadmap? Are there any other derivatives that are on the mind?
Yeah, so I'm calling you from Bitcoin 2025, the next big frontier, which we've kind of highlighted in the Plaza roadmap, and the community has been asking for quite a while, are bonds and leverage on Bitcoin. Bitcoin is clearly the biggest and most desired asset in the decentralized financial system. We think it's a great asset to build bonds backed by because it's much more stable than a lot of other cryptocurrencies. And it's clear from Perpetual's futures interest that people definitely want to go levered long Bitcoin. So it's a natural extension of our underlying mechanism. Other things on the roadmap, we've explored Solana as well because the user interest has been quite high. We like to focus on the highest quality assets in the decentralized financial system. So I would expect that as well in the coming months. But the core thing about our protocol is that we can take any asset and transform the risk reward profile into any number of structures. So opening that up for any user to be able to create any structure on any asset, whether it's an RWA or a crypto native token. We think that's a quite exciting frontier and what we're building towards.
We're definitely at the top of the hour, but I'm just curious, are you guys exploring Bitcoin L2s to build this product on, the native Bitcoin layer, like a wrapped Bitcoin token?
It will be on an L2 as a similar structure to what we did with ETH with kind of Bitcoin liquid staked tokens.
Very cool. Well, if somebody's interested in learning more about Plaza Finance, what's the best way they can get in contact with you and or follow along with the project?
You can follow us on Twitter, Plaza_finance. You can join our Discord community and check out app.plaza.finance.
Awesome. Ryan, thank you so much for taking time out of your Bitcoin conference experience to join the Smart Economy podcast. It was a pleasure to chat with you. I had a ton of fun digging into Plaza. American regulators, I look forward to the day when there's enough regulatory guidelines so that we can use Plaza Finance. But until then, I'll have to keep my eyes peeled on the secondary markets. So thank you so much for your time today. It was a great chat, Ryan.
Thanks, Dylan.
Cheers. Thanks for tuning in to the Smart Economy podcast. To stay in the loop with all our latest episodes and insights, head over to www.smarteconomypodcast.com. And don't forget to subscribe to our YouTube channel for all of our video content. If you enjoyed today's discussion, please consider showing your support by liking, commenting on, and reviewing this episode on your favorite podcasting platform. Your feedback helps us reach more listeners and brings even better content your way. We'd also love to hear from you, so please drop a comment on Spotify or YouTube to share what topics you'd like us to cover or who you'd like to see as our next guest. And if you or someone you know might make a great guest, then please reach out. We're always on the hunt for fresh voices and new perspectives. And for our NEO token holders out there, please consider voting for NEO News today as your council representative. We've proudly been serving the NEO ecosystem since 2017, and will continue to do so by putting portions of our council rewards directly back into ecosystem growth opportunities. With all that said, thank you so much for listening to the Smart Economy podcast, and we look forward to catching you next time.